For the first time in its history, Paytm has shown it can make a profit. In the last 12 months, the company reported a net profit. This is an important step. For years, investors worried that Paytm would only lose money, achieving a positive earnings. Per share, EPS, gross profit, number of shares, shows the business model might work. This happened because the company focused on cutting costs and earning more from its financial services. It shows that management is trying to build a sustainable business, not just a business that grows quickly. This is a big change from the company's old strategy of growth at any cost. Another strong point, the balance sheet. A balance sheet is a snapshot of what a company owns and what it owes. Paytm is debt-free. This means it does not have any loans to pay back to banks. This is very good because it reduces risk. The company also has a large amount of cash, around Rs 7,500 crore. Having this much cash is like having a big safety cushion. It allows the company to handle unexpected problems. It also gives them the money to invest in new opportunities without needing to borrow. This strong financial position is a key advantage, especially when facing challenges. Looking at the long term, Paytm's revenue growth has been impressive. Revenue is the total money a company makes from selling its goods and services. 10-year revenue growth chart, upward trend, showing that more and more people and businesses are using its services. Even with recent problems, Paytm is still a leader in the market. It has millions of merchants who use its QR codes and Soundbox devices to accept payments. It also has a huge base of users. This large network is very valuable. It is hard for a new company to build something similar. This market leadership is a strong foundation. Section 3. The bad, the challenges Paytm faces. Despite some good news, there are bad signs too. The company's revenue or total sales has started to decline. This happened after the Reserve Bank of India put restrictions on Paytm's banking arm. For the financial year that ended in March 2025, revenue was lower than the year before. This is a worrying sign. A company that is supposed to be a growth company should not see its revenue fall. This drop shows that the regulatory action had a real and negative impact on the business. It also led to the company losing some of its market share in payments to competitors, as some customers and merchants moved to other platforms. A big concern is how Paytm is making its profit. The profit we see on paper is not coming from its main business of payments and financial services. Instead, a large part of the profit comes from other income. This is mostly interest earned on the large cash pile the company holds. Its core operations, if you remove this other income, are still losing money. This means the fundamental business is not yet self-sustaining. A healthy company should make profits from what it actually does, not just from the interest on its bank account. This reliance on other income makes the quality of its earnings weak. The company's performance can also be measured by return ratios. Two important ones are return on equity and return on capital employed. These ratios tell us how well a company is using the money invested in it to generate profits. For Paytm, these numbers are very low, even negative in the past. The ugliest part of Paytm's story is the severe action taken by the Reserve Bank of India. The RBI stopped Paytm Payments Bank from doing most of its business. This was a huge blow. The bank was a central part of Paytm's strategy. It allowed the company to offer services like wallets, fast tags for cars, bank accounts. Losing these functions crippled key parts of the business. The bank was supposed to be a low-cost way to manage many small-value transactions and to hold customer funds. The shutdown forced Paytm to change its entire business model overnight. The RBI's action wasn't about one or two minor rule breaks. The regulator pointed to serious, ongoing governance problems. That means the regulator did not trust management to follow rules properly. This loss of trust is very serious. It raises questions about leadership, especially founder Vijay Shekhar Sharma. Losing your main regulator's trust makes growth and operation very difficult. It also scares investors about what other problems might be hidden inside the company. That's a major risk over the stock. The company's history is full of large losses. For most of its life, Paytm burned through huge amounts of cash. Total cumulative losses run into the thousands of crores. Recently reported profit, but look closer at the cash flow. Cash from operations is still negative. Day-to-day operations consume more cash than they generate. To get a clearer picture, let's look at some key financial numbers for Paytm as of October 2025. These numbers provide a simple snapshot of the company's health. The first important number is revenue. For the full financial year ending March 2024, revenue was around Rs 9,978 crore. However, due to RBI's restrictions, the revenue for the year ending March 2025 fell to approximately Rs 8,150 crore. This drop shows the direct financial damage caused by the regulatory action. A declining top line is a significant concern for any business, especially one expected to grow. Now, let's look at profitability. For the last 12 months, Paytm reported its first ever net profit, around Rs 150 crore. This is a small profit for a company of this size, but it's a symbolic milestone. However, it is crucial to look at the cash flow. Cash from operations for the same period was negative, about minus Rs 500 crore. This means the core business operations used up more cash than they brought in. The profit on paper did not translate into real cash in the bank from the business. This difference between accounting profit and cash flow is a critical point for investors to understand. Let's consider the company's financial strength. Paytm has a strong cash position. Its cash and cash equivalents stand at about Rs 7,500 crore. This is a large safety net. The bull case or the optimistic view is a story of a great comeback. Someone who is bullish on Paytm believes the worst is over. They would argue that the regulatory action by the RBI was a one-time event. It forced the company to become stronger and more focused. They see a company that has survived a major crisis, has a powerful brand, still has a massive network of millions of users and merchants. They believe the new focus on profitability is real. They look at the debt-free balance sheet, huge cash reserve. The bull case is that Paytm will rebuild its financial services business with other banks, and its platform will become a high-growth, profitable machine. The bear case, or the pessimistic view, is a story of a broken business model. They would argue the loss of the payments bank is a fatal blow the company can't fully recover from. They see competitors taking market share every day. They point out the profit isn't real operating profit, it's manufactured from other income.